Welcome, everyone. Thank you for joining us for this market update. We're going to talk 2025. We'll also talk what happened in 24. We'll get through the big item questions we're getting quite frequently when it comes to tariffs, when it comes to interest rates, when it comes to inflation, all those key items. What does it mean for the market going forward? We had a big year last year. Does that have an influence on what could happen this year? We'll cover all of that. Before we get too far, though, we always have to mention the disclaimer. Have to put it on the screen. The lawyers and the compliance folks, this keeps them happy when we absolve ourselves of all liability.
Yeah.
Disclaimer up there. And we'll get into starting with what happened. I think that's a great place to kind of recap 2024. What's on the screen here is the U.S. market, the S&P 500. And it was a phenomenal 5-year stretch here. We had some pretty big hiccups in that 5-year, and hiccups is probably putting it lightly. You can see the pandemic decline here, March of 2020. Then you can see the 2022, that's the drop here, which is a longer lasting one. But then a big recovery. You had a big year in 2020, 21, a very good 23 and 24, very strong rally in the U.S. market. Overall, it's been a very nice couple of years back to back. A few reasons why. The biggest earnings growth, companies made lots of money, which helped propel stocks and give it some fundamental footing. You had interest rate cuts. After the big increase in 22, you had rate cuts, you had inflation coming in, a number of factors that provided some tailwinds for stocks, although the Canadian situation, not quite the same as what we see here in the U.S.
No, I mean, and here we're taking a look at the S&P TSX moderate decline. So, I mean, if you take a look, you've got that sort of October 1987 drop in 2020 that it looks like where everything shattered. But as we can tell, it all came back. And then you got all the way through to the beginning of 2022 when things went well. And if you notice, the 2022 decline in Canada was not quite as severe as it was in the U.S. It was still down, but the 2022 decline in the U.S., huge amount of that was the tech fall off that happened after a few years of good run. And again, when we get to 2023, if you look at the Canadian market, it was basically more of a flat line than a straight up line. Again, no real big tech, oil and gas, commodities, banks didn't do as much in that 2023 year, but all of a sudden you get to the 2024 scenario. And as with the US, markets broadened out. And we've had a phenomenal year going forward since. So as you can see, we're still on that continuation path, and we see a little bit more upside coming from that way. But as you can tell, the Canadian market does not play exactly the same as the U.S., never will, just based on the way the markets are made out.
Yeah, I mean, everyone talks about U.S. concentration. Canada's more concentrated than the U.S. in a couple of key sectors, and that really influences how the chart looks here. But we'll talk about both of them, U.S. and Canada, now focusing on where we are today. It's a brief technical summary, looking at a few items. The biggest, in my opinion, is the trend. You want the trend going up. You want those charts going up and to the right, and that's exactly what we see right now, both in Canada with the S&P TSX stock market, as well as the S&P 500 in the U.S. That is very positive. You want to follow that trend. Breadth, that's a jargon term. It really means participation. How many companies are participating in the rally? Is it just a handful that are going up, or is there lots that are participating in the rally? In Canada, breadth is actually quite strong. You have a number of companies that are participating. In the U.S., it has deteriorated in the last month or so. It's really not where we'd like it to be. So that one, not a check mark. Relative strength, that's comparing the stock to other things we could invest in. Stock compared to commodities, stock compared to bonds, for example. And right now in Canada and in the U.S., stock market stronger than those other relative comparisons. All-time high. Right now, neither market's at an all-time high. However, I kept it green because we recently hit a high in both markets, and we're within 5% of that high right now. So we're still very close to that all-time high, and that's actually quite bullish. That's a good news story. Some folks get a little scared when market hits an all-time high. Hey, it's too high, but usually momentum is positive, and investing at all-time highs historically has actually been quite beneficial. So we view that as a bullish item. So you can see the kind of the check boxes there for the most part, lots of green on the screen. And then we'll turn our page here. We are going to get into all the politics, but we got to kind of describe how we view it and describe our theme before we get too far.
Yeah, and that's one of the biggest questions we've been getting. Now that we're getting a new administration entering into the United States, everybody's sort of in a little bit of a panic here. Oh, do I get out? I've had a phenomenal year. Should I bail? The Republicans are in. Is the market going to go down? Well, I mean, as we can see from the chart here, the market doesn't care whether you're Democrat or Republican. They care about other things. They care about earnings. They care about growth, things along those lines. As you can tell by the chart here, everywhere in red or everywhere in blue, there's been up cycles, there's been down cycles. I mean, even if you look at the last 30 years, the Clinton years were really good. The Bush years had a little bit of an upside here and there, but were basically flat. Obama years were good. The first term of Trump went fairly well. So as you can tell, the market does not care whether it's Republican or Democrat in. what their policies are. They can have an effect as to how the markets play a bit, but the markets in general are more worried about what are policies coming in and what are the earnings possibilities, what are the growth possibilities for a company in general, as opposed to who's running the show.
Exactly. So we touched on kind of 24, what happened, 25, kind of setting the stage here. What do we expect? Now, politics in and of themselves don't matter, but in the US, they do have cycles. It's all set in stone. Unlike in Canada, where we kind of just pick the date when we want an election, for the most part, they don't do that in the US. It is carved out, so you do get a very nice cycle, and the market can have some sort of routine behavior with that cycle. Averages, so take it with a grain of salt, but that inauguration year, or what's sometimes called the post-election year, which is what 2025 will be that inauguration year, tends to be volatile. You can see the red box here, that's the first quarter of that year, tends to be flat and a little turbulent. So we do expect more volatility in 2025. This would be one of the reasons why. I should mention this is from All Star Charts. This is their chart that we are using, but that we're at that point of the cycle for the US market where it can be a little more turbulent. Also, we are still in a bull market. 2022 was a bear market. Things went down. Really, from October 2022 onwards, it's been very strong, which is a typical pattern you see with bull markets. One, bull markets are long. They can be 5 to 10 years on average. We've had some that are 12, 13 years. So a 3-year bull market, or in year 3 of a bull market, is still quite young. You still have many more years that are possible with a bull market run. But as you can see, this looks at the average gain of a bull market by year. A lot of growth on the upfront there. A lot of year 1 and year 2 is some big numbers. This is US data from the Carson Group. Year 3 on average can be a little bumpy. You can see far more moderate gains, positive, but after a strong year 1 and year 2 tends to be a little more moderate. So another reason why we think a little more volatility. We are in that part of the cycle where it can be more turbulent. That's the seasonality. And we're in the 3rd year of a bull market, which typically is also a little more volatile. So we have a few reasons pointing to why we could see a bit of volatility in the market. And that's really just the norm when it comes to volatility. In this chart here is not specific to 2025. It is from the Carson Group, but it's just looking in general since 1928 all the way to 2023. That's the data here. Volatility is kind of the norm. How often should you expect dips in the stock market? Well, a 3% dip happens all the time, kind of 7 times per year. A 5% correction is almost nothing. That happens 3 times per year on average. Even a 10% correction is the norm. You get those pretty much every year. I will mention 2024 was unusually calm. We didn't get a 10% correction last year. That's not the norm. So we are expecting a little more turbulence this year. A 15 to 20% probably won't see that. We don't believe that's in the cards. But some of the stuff up front here, those dips and corrections, that's probably more what's in store for 2025. We really didn't see it last year, but that's not the norm. We expect this year to be a little more turbulent, but it's not all doom and gloom here, Kevin.
No, that's exactly. We're going to take a little bit of that worry out of the equation for you going forward, because what we find traditionally is that markets, as we said, you get your bear market maybe lasts a year, 18 months. Your bulls last 5, 10 years on average, or could last any longer. So as Clint showed earlier, we're basically in that early infancy stage of the latest bull run. And as we can tell by this chart showing us from 1950 to 2024, that on your average year, getting a 9.5% gain, you get a 72% chance of that happening. And that is a very positive scenario. And if we go on the next one, where we're looking at, you've had a 20% gain in 1 year, well, your chances of getting 10.6, they're up at 81%. So your chances of a back-to-back are really good. Now, in 2023 and 2024 in the US, we had back-to-back 20% gains. And as this chart shows you, if you've had back-to-back 20% gains, 100% of the time, you've had a gain the next year that's come along. Now, that has only happened 4 times in history, so it's not a long track record to base it on. But as you can tell, we are in that infancy of the market. We are still projecting that the market and the bull is going to run for a while yet. We're not forecasting recession. So even though there may be a little more volatility, we still see positive returns coming from it, and still think that that's the way that you want to be invested going forward, and that this is traditional with what's basically happened over the last 75 years. So now that we've done sort of that scenario, we want to sort of reiterate what our 2025 themes are. As we've mentioned, Clint sat there and described what the volatility is going to be like. We are going to have more of it. We are going to see it probably coming around. So don't expect that everything's just going to be a straight line up. We want to cover the Canadian dollar, tariffs, and inflation. All of them have some sort of a correlation between each other as to how they're going to play things off. And then we'll go into what we think interest rates are going to be. But let's start with that sort of Canadian dollar scenario. And again, the Canadian dollar is hovering around 70 cents. We do see that it's probably going to stay there or within a range, maybe between 65 and 75. We do not see a lot of appreciation coming out of that. And some of the rationale is basically we are in a lower interest rate scenario right now than the Americans. So if investment dollars are looking for something where they get a bang out of their buck, American interest rates are going to pay more. We're not going to have as much Canadian dollars aren't flowing in. You're going to see that the Canadian dollar is going to drop somewhat. The threat of tariffs that we've been seeing coming forward, I'm going to get to that in a minute, but basically that can have a big effect on the Canadian dollar. If we have tariffs coming in, that Canadian dollar may drop a little bit more just based on the tariff scenario and how that's going to work. And so the Canadian dollar is probably going to trade in a bit of a range. We're not expecting huge appreciation. We're not expecting it to fall off the face of the earth at this point. Again, that may depend on a few other things, but it's basically not going to be as strong as the US or gaining on that anytime soon. Leading to the tariff situation, as it has that effect, we have heard Trump say that tariffs are coming in. Now, the biggest factor that we don't know is when are they coming in? How are they coming in? How much are they coming in? We've heard the threats at 25%. Now, is that going to start on day one? Are we going to look at a gradual increase in tariffs going forward? That one we don't know. Until the new administration takes place, the tariff thing is out there. It will hang over the market, and it does have an effect on how the market and the dollar go in hand. But by the same token, until it's actually initiated or we see exactly the way it's going to be, we can't concern ourselves in the long term that this is going to have a huge effect. But in the short term, it may have some more increase to the volatility. And again, with the inflation factor, tariffs can have a big effect on that one as well. Inflation in Canada, as we've seen, it's hit the Bank of Canada's target at 2%, between that 1 and 3 that they're looking for. Basically, if it's there, you can continue to cut rates to help out, or you can maintain things as is. We've got inflation a little bit more under control. The U.S. is a little bit of a different situation. They've been hanging around 3 for a while, and it's a little stickier. It's been harder for them to come down. They're still not getting to that, decline. Their employment numbers came out strong the other day. So you are getting that inflation is going to be harder to come down. And if you put tariffs in place, it's going to make harder for inflation to come down going forward because there's going to be costs that are going to rise. So those are all playing into that factor of 2025 themes. And then with all those added together, it is going to have an effect on our interest rates, isn't it, Clint?
It certainly will. And just to tie it together here, because it is kind of all one story here, we mentioned volatility when we gave you the context of the market, where we are in the election cycle, where we are within the bull market, how last year was unusual. What could cause the volatility? Well, any of these could certainly give you an idea of a catalyst for some volatility. And all of those will tie together also to interest rates. Interest rates likely going to see some cuts on the Canadian side, maybe a few cuts on the US, but to a more moderate degree. What we see on the screen here, this is data I pulled from the Bank of Canada. It's the Bank of Canada's estimated variable mortgage rate. So it's not from any one lender. This is the Bank of Canada's estimate of the variable mortgage rate. Gives you an idea of how mortgage rates have absolutely jumped. You saw that throughout 2022, early 23, and then kind of flatlined and now have started to decline. We do expect Bank of Canada, to lower rates even further this year. They meet 8 times per year. We think 2 to 4 cuts this year. That means half a point, 50 basis points, all the way to 100 or a full percent lower in 25. It's a range. What could impact that range? The things Kevin mentioned earlier. If you do see some tariffs, well, maybe cuts get accelerated on the Canadian side to help support the economy, as an example. On the US side, probably not as many cuts. Inflation's been stickier there. You also have the tariff issue there, which could also lower cuts. But in the US, probably a few cuts, 1 to 3, maybe 25 basis points up to 75 basis points in the US at some point in 2025. The difference in interest rates also plays into the Canadian dollar. One reason we think the Canadian dollar could be weaker is part of that interest rate differential. But in terms of the market, we're talking economy here, we're talking politics. Let's bring it back to the stock market. What we actually invest in is in the individual stocks and in the companies. And as Kevin mentioned, they don't really react to politics. They don't really react to inflation. It's all kind of ciphered down to the earnings growth in the long run. Short term, you can have some turbulence. Longer term, companies make money. They find ways to make more money, and the stock goes up because the company keeps making more money. Earnings growth is simplistically how it works. This is the S&P 500 index, next 12 months earnings per share. The idea here is you've seen this part, right? The stock market in the US did really well in 23, 24, but companies also made a lot of money. So there is some fundamental underpinning as to why we saw that rally, as earnings growth did very well in those 2 years, and the stocks reflected that. 2025, we still continue to expect companies to earn more money, which gives you some fundamental underpinning as to why you could see stocks continue to increase this year as well. Kind of pulling that all together, what do we expect out of 25?
Yeah, I mean, giving our overall view, what we've just described to you, there's going to be a few big themes that we want to really reiterate to you and make sure you understand for where we're coming from on our outlook. We do believe that the U.S. stock market will outperform the Canadian stock market in 2025, again, for a lot of the reasons we mentioned in there beforehand. What you found is that the U.S. market has had more growth. You've had a little bit more consistency, more employment that's gone on. The fear of tariffs and things along those lines will have a bigger effect on Canada than it probably will in the U.S. So even though we do see that the markets will continue to move up, the U.S. stock market still seems to be the place that's growing the fastest and probably the place we want to be. We do think that markets will be likely more volatile than in 2024. As Clint mentioned, we didn't have a single 10% decline. I would lay odds we probably do get one at least once this year at some point, and we will sort of see how things react from there. But we do see volatility creeping in. It's typically where you get it in the third year where things go along those lines, so that's going to continue to deal with it. Interest rate cuts are continuing to be on the horizon for a variety of reasons that we've mentioned ahead, and we do believe Canada will cut more than the U.S. Again, a lot of that has to do with either the tariff scenario or the fact that we are in that inflation range in the bound, whereas the American inflation tends to be a little more sticky. With that, it's going to be a lot harder for them to cut rates. The Canadian dollar will remain weak for a lot of the reasons we've mentioned above. We want to talk slightly about bonds coming back into the mix. As we've said, as interest rates have come down, what you're finding is that okay, people can start buying bonds again, start putting them in there. So if you're getting it now and rates continue to be cut, bonds are a very good portion to have into your portfolio. They're going to add a little bit more, and they're going to give you that safety factor that you want to look at going forward. And we still believe that inflation will continue to cool in Canada, just based on the way things are going, tariff possibilities, slower growth going forward. Whereas in the U.S., it's probably going to remain moderate. That sticky situation is still there, and it doesn't seem like it's going away anytime soon.
Yeah, and what would make us change our mind, because our view's not carved in stone. We don't want to plant and flag and say, this is exactly what we're doing forever. We're going to change as the market changes, because the market doesn't care what we think. We have to be able to adjust. A big item is going to be that trend. Trends are still up, both Canadian and U.S. I'm looking at the technical factors here. If that changes, we've got to change. We don't want to be as heavily invested if trends are down. That's not the case now. Trends are still up. Breadth deterioration, we've already seen some of that in the U.S. Continuing to watch, see if we see that in Canada as well. Relative strength, again, stocks outperforming bonds, outperforming commodities right now. If that changes, we'll have to change our view. Some of the fundamental pieces here, well, if you have an escalation in geopolitics, have actually calmed down as of late, which is good news. But if that changes, we may have to revisit it. Inflation, Kevin mentioned inflation, how it's linked to tariffs. It also links to interest rates, which is on the list here. All of that's kind of the same piece. If we start seeing changes of inflation, changes in the political picture, it could impact interest rate cuts or the expectation of rate cuts. That could impact the market. We'll have to watch for that as well. So a few things we have to keep an eye on, and if they happen, we have to be ready to change our mind and change our strategy. That was a high-level view of what happened in 24, where we think things are going in 25. If you have questions, you can always go to chatwithclintonkevin.com, or you can reach out to us directly. We'd certainly love to hear from you. With that, we'll end it there. Thank you, everyone, for tuning in. Take care.
Take care.